Let us begin with a clear definition. The global financial environment refers to the interconnected system of financial markets, institutions, regulations, and economic forces that operate across national borders, facilitating the flow of capital, credit, and financial services worldwide. For any corporation or investor, understanding this environment is essential because financial decisions are no longer confined to a single country. A company based in Germany may raise capital in New York, produce goods in China, sell to customers in Brazil, and face competition from a firm in Japan. The global financial environment provides the structure for cross-border transactions, but also introduces risks and opportunities absent in a purely domestic setting. In this lesson, we will explore its scope, importance, key components, and underlying principles, using descriptive examples to illustrate how changes in this environment affect corporate finance. The scope of the global financial environment is vast. Corporations raise funds from international investors. Multinational companies manage subsidiaries in multiple currencies and hedge foreign exchange risk. Governments borrow from global bond markets. Even small local businesses are affected by global interest rates and exchange rates. The importance is clear. A financial manager who ignores global factors may make profitable domestic decisions that turn disastrous when a currency moves or a foreign central bank changes policy. Conversely, understanding the global environment allows access to cheaper capital, larger markets, and risk diversification. One fundamental component is the foreign exchange market, where currencies are bought and sold. It operates 24 hours a day across London, New York, Tokyo, and Singapore. Exchange rates are determined either by floating regimes, where supply and demand set the price, as with the US dollar or euro, or by fixed regimes, where a central bank pegs its currency to another, like the Hong Kong dollar to the US dollar. Exchange rates affect the value of foreign earnings, the cost of imports, and the competitiveness of exports. For example, a British company selling in the United States benefits if the pound weakens against the dollar, because dollar revenues convert into more pounds. But if that company borrowed in dollars, a weaker pound makes the debt more expensive. Understanding exchange rate movements is therefore essential. Another key component is the international capital market, which includes the eurocurrency market, where banks accept deposits in currencies other than the domestic currency. A London bank accepting US dollars operates in the eurodollar market, often offering lower borrowing rates due to lighter regulation. The global bond market allows corporations to issue eurobonds. For instance, a French company issuing yen-denominated bonds in London, tapping a wider investor base. The global equity market permits foreign listings via American depository receipts. By accessing these markets, firms lower their cost of capital and reduce vulnerability to any single country's credit downturn. Major institutions shape the global financial environment. The International Monetary Fund provides short-term loans to countries facing balance of payments crises, as seen during the Asian financial crisis of 1997. The World Bank offers long-term loans for development. The Bank for International Settlements sets bank capital standards. Central banks like the U.S. Federal Reserve influence global conditions. When the Fed raises interest rates, capital flows shift and emerging markets may suffer. The 2013 taper tantrum, when the Fed signaled reduced bond buying, triggered sell-offs worldwide. Financial managers must monitor central bank actions closely. Several underlying principles govern this environment. Purchasing power parity suggests exchange rates should adjust so that identical goods cost the same across countries, though it holds only over long periods. More directly useful is interest rate parity, which states that the difference in interest rates between two countries equals the expected change in their exchange rate, preventing arbitrage. Uncovered interest rate parity implies that higher interest rate currencies are expected to depreciate, explaining the risks of carry trades. Another principle is country risk or political risk. A corporation investing abroad faces expropriation, currency inconvertibility, or sudden tax changes. For instance, a mining company might face contract renegotiation. Managers adjust discount rates or seek political risk insurance from agencies like the Multilateral Investment Guarantee Agency. Offshore financial centers, sometimes called tax havens, are also part of this environment. Jurisdictions like the Cayman Islands offer low taxes and banking secrecy. While legal, aggressive tax avoidance raises ethical and regulatory concerns, with initiatives like the OECD's Base Erosion and Profit Shifting project increasing transparency. Financial managers must balance tax efficiency with compliance and reputation. To see how this environment affects a real decision, consider a European car manufacturer building a factory in Mexico. The investment must be evaluated in euros. The firm faces exchange rate risk between the euro, the peso, and the dollar, because revenues will be in dollars from U.S. sales. It faces country risk in Mexico, such as changes in labor or environmental laws. It can use currency swaps, forward contracts, or options to hedge. The global financial environment provides these tools, but also imposes constraints like capital controls. The manager who understands this environment can structure the investment to maximize expected returns while controlling risk. In summary, the global financial environment is the interconnected system of currency markets, international capital markets, global institutions, and regulatory frameworks. Its importance stems from the reality that most corporations now operate internationally. Key principles such as interest rate parity and country risk analysis provide analytical tools. By understanding these components and principles, you will be better prepared to make sound financial decisions in a world where national borders do not separate markets. The successful financial manager stays informed and adapts to changes, while keeping fundamental principles firmly in mind.